You work hard, your paycheck comes in, and the IRS takes a slice before you even see it. It's a simple, unavoidable cycle for most of us, but for the ultra-rich, it's a different game. They live in a financial reality where their wealth grows exponentially, and the expected tax bill on those massive gains often never arrives. How? It's not magic. It's written directly into the U.S. tax code, and it's 100% legal. Over the next 14 minutes, we're tearing down the curtain on their playbook. We'll expose the 3 biggest loopholes that the wealthy use to build and protect their fortunes. The powerful buy, borrow, die strategy. The carried interest to a loophole that supercharges Wall Street paychecks. And the step up in basis, a rule that can erase decades of taxes overnight. Understanding this is the first step to seeing how wealth really works in America. Let's get into it. Buy, borrow, die. The billionaire triple play. This 3-step strategy is the absolute holy grail of tax avoidance for the mega wealthy. It sounds like a morbid joke, but it's a legitimate and powerful financial plan that lets them fund a lavish lifestyle while their fortunes compound virtually tax-free. Step 1. Buy the thing that grows. The first rule of this playbook is simple. Don't hold cash. You park your wealth in things that appreciate in value over time. We're talking stocks in world-changing companies, prime real estate in growing cities, priceless works of art, or entire businesses. Think of Jeff Bezos. His official salary from Amazon has been pocket change for years. His real wealth is in his mountain of Amazon shares. While those shares balloon in value from millions to billions, he pays nothing, zero tax. That's because in our tax system, you only owe tax on a gain when you realize it, meaning when you hit the sell button. As long as you just hold the asset, the growth is what's known as an unrealized gain. The IRS can't touch it, so the wealth just keeps stacking year after year, outrunning inflation and building on itself. Step 2. Borrow, don't sell. Okay, so you're a billionaire. Your wealth is tied up in $500 million of stock. But you need cash. Maybe you want to buy a new private jet, a tropical island, or maybe you just need to pay your bills. The average person would have to sell some assets, right? But selling triggers capital gains tax, and that's exactly what this strategy avoids. So instead of selling, you walk into a private bank that caters to high net worth individuals. You say, "I'd like a loan, and I'll use my stock portfolio as collateral." This is called a securities-based loan. The bank is more than happy to do this. For them, it's an incredibly low-risk loan because the collateral is rock solid and liquid. They'll give you millions in cash at an interest rate that is often incredibly low, sometimes just a couple of percentage points, because the loan is fully secured. And here's the kicker. A loan is not income. So that cash you just received, the IRS completely yawns. It's not a taxable event. You get to live your life, buy your yacht, and fund your next venture, all while your original assets remain invested and continue to grow. This isn't just for a few million. We're talking about lines of credit that can run into the hundreds of millions, used to fund a lifestyle most can only dream of, all without selling a single share. And as a final plot twist, if you use the borrowed money for investment purposes, the interest you pay on that loan might even be tax deductible. Morgan Stanley reported its clients had taken out over $68 billion in these kinds of loans, a figure that has skyrocketed in recent years. Step 3. Die at the right moment. This is the final, most audacious step that makes this whole strategy a generational wealth machine. When the wealthy individual who has bought assets and borrowed against them passes away, their heirs inherit everything. The stocks, the real estate, the art, but they don't just inherit the assets. They inherit them with a magical tax provision called a step-up in basis. Let's say the person bought stock for $1 a share decades ago, and now it's worth $1,000 a share. The basis is the original cost, $1. If they had sold it, they would owe capital gains tax on the $999 gain. But because they died holding it, the IRS essentially says, let's just pretend the original cost was whatever the asset was worth on the day of death. So the heir's new cost basis becomes $1,000 per share. All that appreciation, decades of growth from $1 to $1,000, is never taxed. It vanishes for tax purposes. The heir can sell the stock the very next day for $1,000 and owe absolutely nothing in capital gains tax. The estate uses a small portion of the assets to pay back the bank loan, and the cycle is ready to reboot for the next generation. Buy, borrow, die. It's how fortunes become dynasties, legally. Is your mind officially blown yet? If you're getting value from this and think more people need to understand this blueprint, do me a favor and smash that like button. It tells the algorithm to surface this for others. And if you want to keep getting the real receipts on how money actually moves in the world, hit subscribe and turn on notifications. We drop videos like this every week. Carried interest, the Wall Street two-step. All right, let's move from the generational loophole to the one that supercharges the paychecks of Wall Street's elite, the carried interest loophole. This is the secret sauce for private equity managers, venture capitalists, and certain hedge fund managers. Here's the setup. A fund manager's job is to take other people's money and invest it. For this service, they typically get paid in two ways. First, a small management fee, usually around 2% of the assets they manage. This is taxed as ordinary income, just like a regular salary. But the real money is in the second part, the carried interest. This is their share of the profits, typically a 20% slice of whatever gains the fund makes. Now, you might think that this performance bonus is compensation for their labor, their brainpower and management skill. It should be taxed like a bonus or salary, right? At the top federal rate, that would be 37%. But thanks to this loophole, it's not. The tax code allows them to classify that carried interest as a long-term capital gain, as long as the underlying assets were held for more than 3 years. The logic, as far as the tax code is concerned, is that the profit share is a return on investment, not a payment for labor. And just like that, the tax rate on what is often the largest part of their income plummets from 37% to 20%. Let's put numbers on it. A fund manager who makes a $10 million profit share would pay about $2 million in federal taxes under the capital gains rate. If that were taxed as income, their bill would be closer to $3.7 million. That's a $1.7 million difference on a single year's bonus. Defenders of this loophole argue it's a vital risk incentive that encourages long-term investments that benefit the economy. Critics, however, call it a subsidy for millionaires and billionaires, arguing that these managers are performing a service and their compensation is for labor, not for risking their own capital. It allows some of the highest earners in the country to pay a lower tax rate than many middle-class professionals like nurses, firefighters, and teachers. Despite bipartisan calls to close it for years, intense and well-funded lobbying from the financial industry has kept the loophole alive and well. Step up in basis, the generational eraser. We touched on this in the die step of our first strategy, but this loophole is so powerful it deserves its own spotlight. It's formally called the step up in basis, but a more accurate name would be the generational tax eraser. This single rule is one of the primary engines driving the accumulation of generational wealth among the richest families. Let's break it down with a clearer example. Imagine your grandmother bought a house in a quiet neighborhood back in 1975 for $50,000. That $50,000 is her cost basis. Over the decades, the neighborhood boomed, and now, 50 years later, that house is worth $1.5 million. That's a $1.45 million gain. If your grandmother decided to sell it, she would owe capital gains taxes on that massive $1.45 million gain. But she doesn't. She lives in the house until she passes away and leaves it to you in her will. The moment you inherit it, the step-up in basis rule kicks in. Your new cost basis is not the original $50,000. It's the fair market value at the time of her death, $1.5 million. If you turn around and sell the house the next month for that same price, your taxable gain is zero. Decades of appreciation, $1.45 million of pure growth, have been legally and permanently erased from the IRS's books. All that money, which could have translated into significant tax revenue for schools, roads, and hospitals, has simply evaporated. Now, contrast this with what happens if she had gifted you the house while she was still alive. In that case, you would get a carryover basis, meaning you would inherit her original $50,000 basis. If you then sold the house for $1.5 million, you'd be on the hook for taxes on the $1.45 million gain. The difference between inheriting and gifting is a tax bill that could be hundreds of thousands of dollars. This is why you hear tax advisors say, hold on to your appreciated assets until death. Every budget cycle, proposals surface to eliminate or limit this provision, with critics pointing out that it overwhelmingly benefits the wealthiest households who hold the most appreciating assets. But the counter-argument is often presented with tear-jerking stories about protecting family farms and small businesses from being sold off to pay a massive tax bill, and so far, the rule always survives. So there you have it, 3 of the most powerful legal plays in the Wealth Building Handbook. First, buy, borrow, die, where you grow wealth, live off tax-free loans, and pass it on with the gains erased. Second, carried interest, where Wall Street managers get to classify their massive paychecks as lower-taxed investment gains. And third, the step up in basis, the master key that unlocks generational wealth by wiping out capital gains taxes at death. The most stunning part of all this? It's all 100% by the book. These aren't shady back alley tricks. They are woven into the fabric of our tax code. This is why you see billionaires sometimes reporting a lower effective tax rate than their secretaries. Their income isn't from a paycheck, it's from wealth, and our system is built to tax wealth far more gently than it taxes labor. The good news is, knowledge is power. Once you see the playbook, you have a choice. You can join the growing chorus of voices advocating to change the rules for a more equitable system. Or, on a much smaller scale, you can start to understand the principles, like prioritizing investing over earning and holding for the long term to improve your own financial future. If this clicked for you and you want to continue learning how to navigate the financial world, make sure to like this video and subscribe to the channel. And check out our next video where we'll explore how regular investors can use some of the same principles, like leveraging assets and smart tax planning, without needing a private banker. You won't want to miss it.